It's probably been better for our portfolios than for many others because we are a little bit more of a defensive organization in how we invest. And so the rotation has been a little bit more helpful to us over the last month. And, the volatility is definitely kind of renewed that we had earlier in the year. It's kind of brought back. It is flashing yellow, though, the markets in some ways. I mean, certainly when I look at, I'm become obsessed with the yield curve and how flat it is. And if the Fed raises rates again, in September, as everyone thinks they will, how much flatter does it get unless they get that, 10-year and 30-year moving up? So that's a definite sign. And before every recession, you do have usually rate hikes. You do have strong earnings. You do have
You're using the word
jobs.
Recession. You're worried about a recession. When I hear you talk about the yield curve and just before a recession, earnings are always strong. You're worried about the R word.
I'm not. I will say this: the market has moved up a lot, right? And the Fed has been very slow and gradual with their interest rate hikes. So I think that's nice that they've been slow and gradual, because if they do need to reset a little bit or even just slow down or pause, they really haven't set themselves up. I mean, what you usually have is explosive sort of PE expansions coupled with fast rate hikes, and that causes a recession. We don't have the explosive PE growth, and we don't have the fast rate hikes either. So I think if we have a slowdown to maybe a mild pullback, I think it could happen. I think we can handle it.
Bill Stone, you disagree. Why?
Yeah, I mean, it obviously depends how you define yellow, but I just think, yes, okay, if you say we're probably on, certainly in the second half of this expansion, well, it's going on so long, I don't think that's going on a limb. I think the thing is, I just think anything you watch or anything I watch, you're not really getting the signal that we're close to a recession. So I'll give you two quick things. One is the yield curve. Yes, we've seen it flatten when you define it on the 10-year yield minus the 2-year yield. I'm not sure that that's the right one to look at anyway. I think that the problem is if you look overseas, you have, the German 10-year at 0.3%, the Japanese 10-year at about 0.1%. I suspect the curve in the U.S. is flatter than it otherwise would be given all the quantitative easing going on. If you look at some other curves that the Fed has put out that they think make more sense to look at, you don't get the same story of tremendous flattening.
So, Bill, you disagree with PIMCO's red warning signal. You say it's more like a yellow. What does a yellow warning signal portfolio look like?
Yeah, and I don't even know it's yellow. I still think you say the economy is still, I'll argue, still going strong. Yes, we posted 4%, 4.1 to be technical in the second quarter GDP. We won't see that again likely in the third quarter. We're still likely to be around 3%. So,
right, so how are you investing as a result of that view?
Oh, yeah. So I think you stay with, I think technology still looks good. I even think energy that will continue to benefit from faster growth. I think those are the place. And if you want to look overseas at a place that hasn't caught up as much or, hasn't gone as well as the U.S., Japan, they really depend on global growth. If you think global growth continues like I do, I think it's a place to look. It's much cheaper and a better dividend yield.